The Dow Jones plunged more than 800 points Wednesday, its worst drop in 8 months, while the S&P 500 sank more than 90 points. Tech companies saw the sharpest losses as analysts say investors are worried about rising interest rates. Martin Baccardax is London bureau chief for TheStreet.com, and he joins me now. Martin, thanks so much for being here.
Very welcome.
Were you surprised to see such a large drop today?
I really was. We were looking at the start of the trading at the opening bell, kind of in and out of positive territory, an ordinary day. The losses begin to mount and then suddenly began to escalate and tumble, and we saw the sharp declines that we saw today. You mentioned tech stocks. In fact, the NASDAQ Composite had its worst day in 7 years today, which is absolutely astonishing.
So why is that? Why did some tech stocks suffer such big hits?
They're very sensitive to rising interest rates because they do carry a lot of debt as they're trying to expand their businesses. So the higher the interest rate and borrowing costs, the more pressured their profits become, and therefore investors will take some of the money out of the market as a result. But put it into context as well, in that tech has led the gains for most of the year. This is a little bit of profit taking as we head to the final months. If you're an investor who's been sitting on a 25% gain, you don't mind losing 2 or 3% today and maybe just sit it out until Christmas and figure out what happens.
Well, so what are some of the other factors, though, that helped fuel this sell-off?
Well, the president mentioned it today, in fact, when he was critical of the Federal Reserve and their interest rate policy. He thinks they're moving a little bit too fast. There are some who agree, and there are others who don't. It has to be remembered the U.S. economy is running at the fastest pace in more than 5 years. It's probably going to continue that into the end of the year and probably into next. Unemployment at the lowest since 1969, and we're earning a little bit more every week. Inflation is pretty tame, so the Fed is moving maybe a little bit more quickly for some, and maybe not as quick for others because they look back to the financial crisis and think, the Fed was a little bit slow back then, and look what happened.
Well, so let me ask you this, though, because the Dow is still at a record level. Yeah. So overall, is this just a blip? Is this just a momentary sort of blip on the radar screen? When you look at the overall economic health of the country, how does that picture look?
I think it's still doing terribly well. Again, one of the best paces in 5 years. We're probably going to see corporate profits over this quarter rise around 20%, and then again for the final 3 months of the year. That's really healthy earnings and really does illustrate some of the things that the president is doing. Now, what investors are concerned about is what happens in 2019 when the impact of tax cuts starts to fade away and the Federal Reserve begins to hike interest rates, and probably most importantly, what is going to happen with the ongoing trade tensions between Washington and Beijing and the tariffs that are piling up. At the moment, they sit at $250 billion. They could rise to $500 billion by the end of the year and then begin to impact things like consumer products and the iPhones and the tablets and everything else. That could have a really significant impact on consumer spending and then have a cascading effect into stocks and everything else. So we may not know the true story for a couple of months now, but this might be one of the first warning signs.
So how quickly can the market rebound from what we've just seen? Is that something that you would expect relatively quickly will correct itself?
It's a great question. I think we are all going to be fascinated what happens overnight in the Asian markets. China has wobbled for the last few weeks as a result of the trade war. If it follows suit from what we saw on Wall Street today, we could see more selling Thursday, and then potentially into Friday. But what I think is going to happen is with the bank earnings beginning on Friday and then the larger corporate earnings starting next week, we'll start to see some of those good numbers. A lot will depend on what the companies themselves are seeing in the months ahead, and then we could potentially steady the ship. I still think the market is good until the end of the year, and this is what we call a healthy correction. Sometimes it doesn't hurt to take some of that steam out so that we can maybe focus on underlying fundamentals rather than the sugar high that some people have described it, which has been built on the tax cuts.
So if you're an investor right now and you're feeling a little nervous, what are you thinking?
That's a great question. I'd say don't worry. If you truly believe in the market and the fundamentals of the companies that you own, you have a chance to buy them more cheaply now. And if you're willing to be patient for a couple of days, you could actually make a little bit more money. If you've seen the value of your 401k decline a little bit, don't be terribly concerned, but pay very close attention to rising interest rates and what happens in the Asian and European markets over the next few days. That will give you an excellent indication of what to do next, and then watch corporate earnings in the weeks ahead. Those collectively will give you exactly the kind of picture that you're going to need. But don't forget, the underlying fundamentals of the U.S. economy are still very, very good. People who want to work can work, and as a result, they're going to be able to spend. Spending drives 2/3 of this economy, and it's the biggest in the world. So those simple equations in the overall arithmetic of the market are still very good, and I really do believe we'll probably bounce back from this.
All right, Martin Baccardax, great to have you here. Thank you so much, Martin.
Thank you.